coronavirus is paralyzing the real economy, but the stock markets continue to fly, hovering over their all-time highs. Why? The virus is real. The stock market is a hoax. The stocks are on crack. There are, we believe, 4 reasons. The main reason is that 66% of the Wall Street exchanges are now in the hand of robots and algorithms, which cannot be taken by emotionality. So while the central banks put the effects of the disease into their forecasts, the machines believe that the crisis will have a temporary effect. If they are right, then you can say goodbye to human traders. Here are the 4 main reasons why the stock markets are snubbing the epidemic. We do not know how much the coronavirus epidemic will spread worldwide, nor how long the emergency will last, nor how severe will the effect be on the global economy. But we know one thing: the stock exchanges don't seem to care much. Because even before having the answers of science, the stocks have managed to return to historic highs in recent days. There are at least 4 reasons for this strange reaction, right or wrong. 1. The widespread opinion on the markets is that the virus will have only a temporary impact on the economy. 2. Central banks continue to support the market. 3. Investors are overexposed on the bond market, which now offers reduced returns to the bone, so they will be forced to invest in the stock exchange. 4. Markets are now dominated by algorithms, which have, it will seem trivial, less emotionality than human beings. Economy and viruses. The general opinion that turns on the markets is well summarized by Emmanuel Cao, Barclays head of equity strategy for Europe. The idea that the impact on the economy will be transitory is widespread among investors. Coronavirus will slow down growth, that's for sure, but it will hardly derail it. Indeed, we believe that much of what is lost in this quarter will be recovered in the following ones. Just look at Barclays' estimates of GDP growth to understand the concept. Before the coronavirus, the British Bank forecast, by 2020, global GDP growth of 3.7% in the first quarter, and 3.2% in the second. Now, however, he estimates a much slimmer first quarter, plus 1.8%, but a much more nourished second quarter, plus 4.2%. And a Reuters poll of 40 economists launches the same message: a brake hit now, an acceleration later. And if the GDP does not derail, even corporate profits should not do it. The estimates on the profits in 2020 of the companies listed on Wall Street have, in fact, fallen from plus 9.6% at the beginning of the year to plus 8.1%. Only a slight filing, which does not detract from the recovery compared to the 1.7% growth in 2019. Of course, investors know well that they can be wrong. For this reason, everyone, including Barclays, suggests hedging by hedging risks. But the general trend remains positive on the markets. The parachute and the rates optimism is then determined by the attitude of the central banks. In 2019, globally, 48 of them cut rates. Overall, 88 times for a total of 9,000 basis points, according to calculations by JP Morgan. In addition, the central banks have restarted to print more money. And the US Fed, even without real quantitative easing, has injected $420 billion liquidity into the market since September. Investors also bet that if the situation worsened, central banks, at least those that still have room for maneuver, could intervene with greater force. In short, the widespread opinion is that, in any case, there is a parachute for the economy and the markets. This reassures a lot. Not only the ultra-expansive monetary policy created another factor that could support the stock exchanges. Yields on bond markets fell a lot in 2019, but, despite this, fears for the US-China trade war have pushed investors more to bond markets than on the equity ones. Asset managers are overexposed on bonds, notes Barclays Cao. With the coronavirus, the shares of the most exposed companies in China have not yet returned to previous levels. This is, therefore, an opportunity to return to the market, obviously with risk coverage. The algorithm has antibodies, but it is not just a question of liquidity or confidence in central banks.